Hello everyone. Can you people hear me? Okay, good morning everyone. Walaikum assalam. Well, few students had a problem contacting me, so I'm sharing my contact number, WhatsApp number on the screen along with my Facebook. There's a problem with the Facebook. It's EJJAZ actually. So there's a Facebook link and there's also my YouTube channel link. Shahroz, I'm fine. Walaikum assalam. Hello, Aisha. Okay, I hope you people have noted down the contact number. Okay, let us start. And uh, when we started uh, discussing the types of risks, and we were discussing systematic risk, business risk, and financial risk. We had discussed what business risk is and what financial risk is. Uh, let me give you a quick recap of what business risk is, where a company is not making enough sales to cover its operating costs. So the risk of not covering the operating cost is actually the business risk. And the risk of not paying the liabilities, interest payments on time is called the financial risk. Business risk will be faced by every company. Financial risk is only faced by the company which has debts in its capital structure. And if a company has debts in its capital structure, it will be called a geared company. So financial risk is faced by the geared company only, whereas business risk is faced by both geared and ungeared company. Both types of risks are denoted by equity beta. Equity beta reflects both type of risks. But in case a company is an ungeared company, that is 100% equity finance, it has no loan in its capital structure, then its equity beta will show only the business risk. But for a geared company, the equity beta will show both business and financial risk. And we have studied the CAPM model. It uses the equity beta, that is, it should incorporate both business and financial risk. So it's going to reflect both business and financial risk. So before we can use equity beta for a CAPM calculation, we will make sure that it reflects both business and financial risk of the company investing. Let us look at this example. Alpha company is considering to invest in beta company, which is involved in manufacturing of smartphones. Okay, we have discussed this question. I'm sorry. This is the one. Alpha company is considering to invest in beta company, which is involved in manufacturing of smartphones. The current return on government bonds is 7%. The average return by the companies operating in smartphone manufacturing industry is 12%. The equity beta is 1.5. The equity beta of beta company is 1.5. It's not beta company, it's actually alpha company. And beta company has a debt to equity ratio of 40/60, whereas alpha company has a debt to equity ratio of 30:70. We'll discuss it. What is it? If corporation tax rate is 30%, calculate the cost of equity of alpha company. Since alpha company is going to invest in beta company, so we need the cost of equity of alpha company, which it will use for investment appraisal purpose. Now, the equity beta of beta company is 1.5. Alpha company is investing in beta company, and beta company has the equity beta of 1.5 times. And we know that we are going to calculate the cost of equity of alpha company. So we need equity beta of alpha company and not the beta company. Since alpha company is investing in beta company, when alpha company will be investing in beta company, it will have two types of risks. One is the business risk and the other is the financial risk. Since it is investing in beta company, its business risk will be the same as of beta company. So it will have the same business risk as beta company. But since it has different debt to equity ratio than beta company, therefore its financial risk will be different. If you look at this information, beta company has equity debt to equity ratio of 40:60. It means 40% of its capital is debts and 60% of its capital is equity. On the other side, alpha company has a debt to equity ratio of 30:70. That is, its total capital will have 30% of debts and 70% of equity. Now my question to all of you is, which of these two companies will have higher financial risk? Yes, Ubaidullah, we need investors equity beta for CAPM. Then Aisha, no, it's not alpha company, it's beta company. If you look at the beta company's debt to equity ratio, it has 40% debts, whereas alpha company has 30% debts. So the company having more debts will have more financial risk than the company having less debts. Remember, of the total capital of beta company, 40% are debts. So it will be facing the financial risk more than the alpha company, which has only 30% of the debts. I hope now it's clear. Everybody who was saying alpha company has a higher risk, I think it's now clear. Okay, so we can't use beta company's equity beta because it does reflect the business risk which will be faced by the alpha company, because beta company and alpha company will be in the same business, so therefore it will have the same business risk. But since alpha company is less geared than beta company, it has a lower financial risk. So we can't use the equity beta of a beta company for alpha company. So what we have to do is we have to offload the financial risk from the equity beta of beta company. If we do so, we will be left with the business risk only. Then we have to incorporate the financial risk of the alpha company to get the equity beta of alpha company, which will be reflecting both business risk and financial risk of alpha company. Now, how we do it? We have got two steps for doing this, and the third step will be calculating the cost of equity. So what we have to do is we have to ungear equity beta. What does that mean? Ungearing of equity beta means we will be removing financial risk from the beta value. And how we can do it? We have a formula of converting geared beta into ungeared beta and ungeared beta into geared beta. Whereas beta A is actually asset beta, or we can call it ungeared beta. Remember, this ungeared beta reflects only business risk. It only reflects business risk. Kindly hold your questions at the moment. If you have any question in your mind, put it down somewhere with you, and I will give you time to ask questions, and then I'll come up with all the questions. I won't move forward unless I've explained and I've answered your questions. So just listen carefully. This asset beta is also called ungeared beta, and remember, asset beta reflects only business risk. It reflects only the business risk. So all we have to do is to convert the equity beta of the beta company into asset beta, so that there is no more financial risk of beta company into the beta value. So let's take the equity beta of the beta company, that is 1.5. Since it has financial risk of beta company, so we will use a beta company's gearing ratio to remove the financial risk. Remember this. So what is the gearing ratio of the beta company? The beta company has a debt to equity ratio of 40:60. So 60 is equity, so we'll write 60 in numerator, then we'll divide it by 60 plus 40. But 40 should be after tax. Tax is 30%, so we'll have to remove 30%. That is, we'll write 70%. So we'll take 70% of 40. Can anybody calculate this figure for me? What will be the value of, okay, 1.023. Okay, thank you. 1.023. Now you can clearly see the geared beta was 1.5 because it was also showing the financial risk along the business risk. But this value is lower than the equity beta because it no more has financial risk in it. We have offloaded the financial risk of beta company from this value. Now it purely reflects the risk of the business, the risk of the business only, and it does not have any financial risk. Now, since alpha company is investing in beta company, so its business risk will be the same as of beta company. So this risk factor will be applicable in case of alpha company. But since this does not have any financial risk and alpha company is a geared company and it has financial risk, so we have to incorporate the financial risk of alpha company. And how we do it? First, we ungeared the equity beta, and this time we have to gear the asset beta. We have to gear this beta and convert it into equity beta to reflect the financial risk of alpha company. So we'll again use the same formula, but this time we have asset beta with us, which is 1.023, and we have to find equity beta, and we'll be taking the gearing ratio again, but this time the gearing ratio should be of which company? What do you think? Which company's gearing ratio should I be using? Yes, it's Alpha Company, because we have to incorporate the financial risk of Alpha Company. Therefore, we have to use the gearing ratio of Alpha Company. So Alpha Company has a gearing ratio of 30:70. So equity is 70. So 70 plus 30 into 70%. So just solve this fraction first, and then divide it here, and tell me the equity beta, the geared beta for Alpha Company. What's the value of geared beta this time? 1.329. I can write 1.33, right? Everyone else should cross-check this value. Is it the correct value? It's 1.33, yes? Okay. Now, if you see, the equity beta of Beta Company was 1.5, whereas the equity beta of Alpha Company is 1.3, lower than the Beta Company's equity beta. And what is the reason? Why do we have lower equity beta for Alpha Company than Beta Company? Can anybody tell me the reason of having lower equity beta in case of Alpha Company than of Beta Company? Yes, 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 everybody is coming up with the right answer, because the gearing of Alpha Company was lower than the gearing of Beta Company. Therefore, it has a lower equity beta because it has lower financial risk. Both companies have the same business risk, but because of lower financial risk of Alpha Company, it has a lower equity beta. I hope it is clear now. Okay, now last step, calculate the cost of equity. Now we'll use the same formula of the CAPM formula for this. Now we know how to calculate the equity beta. So let's put the values. We know that the government bonds, the return on government bonds will be considered as a risk-free rate of return. So we'll write 7%. Now we've calculated Alpha Company's equity beta, that is 1.33, which shows that Alpha Company is 1.33 times riskier than the average market. The market return is 12% minus 7, the risk-free rate of return. And what's the final value? 13.65%. Okay, thank you. Now remember one thing. You might be disguised in an exam question. Sometimes the examiner does not give the market return. It straight away gives you the risk premium, market risk premium. The difference of the market return and the risk-free rate of return is 5% in this case. It is actually market risk premium. So sometimes he might give you this premium, so you don't need to subtract anything, just put it in the formula. So if the question has given you the market risk premium, just put it here. You don't need to subtract anything, just multiply it with the equity beta and add the risk-free rate of return. So do read the question carefully. Sometimes it might give you the market return, and sometimes it might give you the risk premium, the market risk premium. So you don't need to subtract anything from the market risk premium. Now, 2 minutes for you people to ask me any question. Otherwise, we'll move forward. But try asking the questions one by one so that I can answer everyone. Can you please explain the first step? Yes, Rizwan. We were given the equity beta of beta company, which is 1.5. And I told you that the beta equity beta reflects both business and financial risk. Since it's the equity beta of beta company, so it reflects the business risk of beta company and the financial risk of beta company. But we are not calculating cost of equity for beta company. We are calculating it for alpha company. Since we are calculating it for alpha company, we need business risk and financial risk of alpha company rather than beta company. Alpha company is investing in beta company, so it will have the same business risk as of beta company, but different financial risk because of its different gearing. Beta company has 40% debts, whereas alpha company has 30% debts. So it has lower debts than beta company, therefore it will have lower financial risk. So from this 1.5 times beta, the business risk of alpha company will be the same, so we can use the same business risk as of beta company, but we can't use the financial risk of beta company because beta company has different financial risk. So what we have to do is we have to offload the financial risk from this 1.5 figure. And this we can do by ungearing this equity beta. So we have a formula for gearing and ungearing the equity beta. The ungeared beta is actually equal to the geared beta into equity divided by equity plus debts. So all we have to do is to put the equity beta here in this formula, and we have to use the debt to equity ratio of beta company in this case, because we have to offload the financial risk of beta company. So we'll be using the debt to equity ratio of beta company. We've just put the values to calculate the ungeared beta, which will only show the business risk. I am confused in ungearing equity beta of proxy company and gearing asset beta of proxy company. I mean, where to put which company's data. Uzair, you have to take the equity beta of the proxy company in the first step. You have to take the equity beta of the proxy company in the first step, and you have to take the gearing ratio of the same company. So we will use same company's gearing, that is the proxy company's gearing, to ungear its beta. Once we are done with that, we will be having the asset beta, that is ungeared beta. Then we'll use the same formula again and convert the asset beta into equity beta, but this time we will be using the gearing ratio of the investing company, so that the investing company financial risk is being incorporated. Okay, Sikandar, I will come up with that. By the end of this lecture, I will tell you which question you people are going to solve at home. Can also equity risk premium be used to mean the risk premium? Can also equity risk premium be used to mean for Cherono, I didn't get your question. Can you just explain? Do I calculate 30s to 70, or is it's so is the gearing always given in ratio? Most of the times it will be in the form of ratio, or you might be given in percentage as well. They might give you gearing as a percentage of total capital. For example, 40-60. What does 40-60 mean? But I'll just take this one. 30-70. It might be given as 30% because the total is 100. Of the 100, 30 is debt. So they might give you 30 as a percentage of a total capital rather than as a ratio of debt to equity. Proxy company, Taha, proxy company means For example, if we are planning to start our business of manufacturing cement, and we don't know what the business risk we will be having. So what we do is we will take a similar company involved in cement manufacturing, which will have the same level of operations as we are planning to have. That company will be acting as a proxy company, means we'll just take the business risk of that company as our business risk. So we are using a similar type of company, and we're using its information for our sake. So it will be acting as our proxy company. So how the beta assets for both the company are the same. Beta of assets will be same because alpha company is investing in beta company. So if beta company fails to cover its operating cost, uh, automatically alpha company will not get anything out of beta company. So it will have the same business risk. Its profit depends on beta's company's activity level. So it will have the same business risk. Rishab, you can't say it's a dummy company. It will be an actual company in the business, but since it will be operating in the same business as we are planning to, so we can use its information as our information wherever possible. So we take it as our proxy company. Where can I ask a question from teacher? You can ask in the same way where you have asked this question. So you can write your question in the same chat box. Asset beta represents only business risk. Yes, Wahab. Uzair, yes, it shows the business risk only. So it's possible in question investing company invest in different business. Yes, in whatever business. Remember, Ubaidullah, in whatever business it is planning to invest, we will take a company which is operating in the similar industry, in the same industry, having the same level of operations as we are planning to have. So we'll use information about that industry. Sir, is McDonald's and KFC has the same business risk? Yes, because apparently both have both seems to have the same level of operation, so we can say that it will have the same businesses theoretically. Practically, definitely McDonald's and KFC might have different risks, but since we can't uh, get things in perfection, so in theory we can assume that the KFC and McDonald's will have the same risk. Apparently, it seems like they have same risk. Similarly, Pepsi company and Coca-Cola, we can say they have same level of business risk. Okay, let's move forward. Uh, so before we can use equity beta, we have to make sure that we have equity beta of the investing company and not any other company. So if we have been given with the equity beta of any other company which has the same business risk as of the investing company, we will just ungear the equity beta of that company, and we'll calculate the ungeared beta, and then we will again incorporate the financial risk of the investing company and calculate the geared beta. In case alpha company was ungeared company, remember, if the alpha company was ungeared company, that is 100% equity finance company, its equity beta would have been the same as its asset beta. 1.023. There would have been no change to the asset beta. The asset beta of the beta company should have been treated as the equity beta of alpha company, since alpha company will have no financial risk in case it was ungeared company. I hope you have understood it. Let's move forward now. Let's go to the cost of debts. We are done with the. So can you please explain the 100% equity? Assume that alpha company was fully equity finance company. What does this mean? It means it will have no financial risk. And since it has no financial risk, there is no point of gearing its asset beta and incorporating any financial risk because it has no financial risk. So its asset beta, the asset beta that we have calculated in the first step should have been treated as its equity beta as well. So it would have the same asset beta and equity beta since it has no gearing. So if beta company has debt to equity ratio of 30 to 70, same as alpha company, then we can, if the alpha company had the same debt to equity ratio as of beta company, then it would mean that its beta company, that is 1.5, should have been used as equity beta of alpha company. There was no need of gearing and ungearing at all. The same equity beta would have been used for alpha company. We did not need to change any beta values. Okay, let's move forward. Cost of debt. Now we are done with the cost of equity. We had discussed three models: dividend valuation model, dividend growth model, and the CAPM model. We've also discussed how to gear and ungear the beta values. And now let's move to calculate the cost of debt. Now the slide that is shown on your screens is a very, very important and useful slide for your examination. Do remember this, do memorize this slide. It's a very important one. How you calculate the cost of debts of different types of debts. First of all, the cost of bank loan. Remember, bank loan will have no market value. It is not a tradable debt. So there will be no market value incorporated in the cost of debt. So it will be very simple. All you have to do is to take the interest percentage. Say, for example, a bank is asking for 8% interest per annum. But we all know if we pay 8% interest, it will reduce our tax liability because interest is a tax allowable expenditure. So if we pay 8% on one hand, on the other side, we will save some tax on it. So we will always take it after tax, net of tax. So let's say the tax rate is 30%. So we'll take 1 minus 0.3, that is 70%, and we'll multiply with 8, we'll get 5.6%. So our cost of debt of bank loan will be simple, that is 5.6%. Yes, Aisha, you're right. So it's 5.6%. So this is very simple. Then we have cost of irredeemable preference shares, the shares that will stay in the business for indefinite period of time. How to calculate the cost of it? We will take preference dividend per share. Say, for example, the preference dividend 9%. And the par value is $1. Remember the percentage dividend is always applied to the par value. Never apply it to the market value. So if we are going to calculate preference dividend per share, we'll take the percentage of the preference dividend and multiply it with the par value of the share to get the numerator value. So never ever multiply it with the market value. It will always be multiplied with the par value of the share to get the numerator value. So once we have calculated the dividend per share, we will divide it then by the market price per share. For example, the preference dividend is 9% of $1, which means 9 cents. 9 cents, $1, 9% of $1 is equal to 9 cents. But this share is being traded at $2 per share. So from the investor's point of view, he will always compare this dividend per share with the market value and not with the par value, because his value of investment is actually the one which is traded, which is in the market rather than in the books. So the investor will always compare his return with the market. So this is the market price per share. So we are actually paying 9 cents against a $2 value of share. So we'll multiply it with 100 to get the cost of irredeemable. If you see, there is no tax impact shown in this calculation. Remember not to show tax impact on preference dividend, because dividends do not qualify for any tax allowable expenditure. So it will be very simple again. Then we have cost of irredeemable debentures. If we have irredeemable debentures, like we have irredeemable preference shares, or we have irredeemable interest-bearing securities, I would say the best word will be interest-bearing securities, irredeemable interest-bearing securities. The only difference will be we have to make it after tax. 1 minus tax. So we'll take interest and we'll deduct tax from it, and we'll divide it with market price. It's not per share, sorry, it's interest per debenture or loan stock per debenture. Just make correction in this. So what we have to do is we have to take the interest per debenture. Usually the assumed value of a debenture will be $100. So what we're going to do is we'll take interest per $100 in the numerator. Again, the interest percentage will be applied to the par value of the debenture, which is usually supposed to be $100. So we'll take the interest per $100 and divide it with the market price per debenture to get the cost of debt. Then we'll move towards cost of redeemable debt. Now, whether it's redeemable preference shares or it's redeemable debentures, we have to calculate the IRR. Remember, all these values are what we have calculated, the cost of debts. These are IRRs. But when we say KD is equal to IRR, we mean the method used for calculating IRR. This 5.6, even this 5.6% can be called as IRR. So remember, this is even IRR, but here calculating IRR is very simple. But in case of redeemable debts, the IRR here that is the cost of debt here, will be calculated using the method that we have used in calculating the IRR investment appraisal. So we'll use the same method. We'll discuss in a while how do we do it. So we have to use the formula for IRR to calculate the cost of debt of redeemable debt. And why are we calling it internal rate of return? Can anybody tell me why are we calling cost of debt as internal rate of return? Simran, interest per debenture means, if, for example, if we have 7% debentures in issue, 7% debentures in issue, usually debentures will have $100 par value. So what is 7% of $100? It's $7. So this is $7 is the interest per debenture. This is the amount of interest per debenture that we are going to pay. NPV should be 0. No, NPV should not be 0. Actually, what was internal rate of return? If you go back and see, the internal rate of return was the return that investor was getting from a project. It was the percentage return that the investor was going to get. Now, if there is a loan, there are two parties. See, look, suppose this is company, and this is the person to whom the company is planning to issue debentures. So this company knows that it has to invest, say for example $100. If it is getting 7% return every year, it means it has a return of 7%, that is, it has an IRR of 7%. If it is return for B company, then definitely who is paying this? Company A is paying this. So what is return for B company is actually the cost of A company. So for A it is cost of debt, whereas for B it is the IRR. So if you calculate the IRR, it is actually the cost of debt of A. That's why we call it IRR, remember. No, we're just looking from the investor's point of view. If what is return for the investor is cost of debt of the company, it is actually the mirror image. So what A is paying is something received by B. So for B, it's return, and for A, it's cost. Simple. So we're just calling it IRR because it's the return of the investor, whereas it's the cost of the payer. So the company is paying, therefore it is its cost, and the investor is receiving it, therefore it is the return of the investor. That's why we call it IRR. The cost of debt is equal to IRR. So it's a mirror image. Remember this. So we have to calculate the IRR. We'll see how we calculate it. Now let's come to the last one, that is cost of convertible debt. In case of convertible debt, remember one thing. What does it mean, convertible debt? It means that it gives the option to investor at some point in the future whether he or she wants to redeem its investment or it wants to convert its investment into ordinary shares of the company. For example, a company has issued $100 debenture with an option of conversion. It has a 5 years life. After 5 years, the investor will have the option of getting these $100 back or take shares against these $100. So it will have the option of converting debt into share capital, but it will be at the discretion of the investor and not the company. So we would not know what the decision will be, whether the investor will be converting it into shares or it will be redeeming. So what we have to do is, before we calculate the cost of debt, in the first step, we have to see what the investor is likely to do. We'll assume that the investor will be rational and he will choose the best option. If the value of shares will be higher after 5 years, he will go for conversion. If the value of redemption is higher than the value of shares after 5 years, he will go for redemption. So first of all, we have to see what the decision of the investor will be after 5 years, and then we will calculate IRR. And why we are going to do it, we'll discuss it in a while. So let's look at this question. Rupap Gavani, it's a December 2008 question. So how to calculate the market value when there is a conversion? We'll see, Mohammed. We're going to discuss it. We will see the calculation now. Rupap Company has in issue 5 million shares with a market value of $3.81 per share. The equity beta of the company is 1.2. The yield on short-term government debts is 4.5% per year, and the equity risk premium is approximately 5% per year. The debt finance of Rupap Company consists of bonds with a total book value of $2 million. These bonds are pay annual interest of 7%, before tax of 7%. The par value and the market value of each bond is $100. Rupap Company pays taxation 1 year in arrears at an annual rate of 25%. Capital allowances on machinery on a straight line. Okay, we don't have to do anything with this. Okay, can you people calculate the cost of equity? Cost of equity of Rupap Company. Just calculate the cost of equity of Rupap Company. Just quickly calculate the cost of equity of Rupap Company. And tell me which model we will be using. Will we be using the dividend growth model or will we be using the CAPM model? Well, Abrar, which of your question has not been answered so far? CAPM model. Yes, nowhere in the question it is mentioned that we have to use CAPM model, but we can easily guess from the question information that which model is going to be used. Since all the information was information that we use in CAPM model, therefore we are using CAPM model. So in exam question, you might not see the examiner using the word CAPM model, dividend growth model. It will straight away ask you to calculate the cost of equity. So we have to judge from the information in the question that which model should be used. So it's yes, it's a CAPM model, and the cost of equity will be risk-free rate of return is 4.5%. Equity beta is 1.2, and market risk premium is already given, so we don't need to subtract anything from it. So it will be 10.5%. The cost of equity is 10.5%, right? Yes, everyone is right with the question. Aisha, I don't know what's 23.55%. Yes, Mohammed Allah, you're right. So it's 10.5% using the CAPM model, but it has asked for calculating the after-tax weighted average cost of capital. And to calculate the average cost of capital, we also we not only need a cost of equity, we also need cost of debt. So we need to calculate the cost of debt as well. First of all, just look at the type of debt we have. Which type of debt do we have? Is it redeemable or irredeemable? Wahab, where did you send me messages? You're talking about the same chat box you're texting right now, or you have sent it to me on my contact number? Sana, Sana is saying that it is irredeemable. Sana, how can you say it's irredeemable? Yes, Wahab, I'm getting your messages. Sana, how can you say it's irredeemable? Everybody should pay attention. Nowhere in the question it is mentioned that it is irredeemable. Sana, how do you say it's irredeemable? My question was, Simran, that whether the debt is redeemable or irredeemable. Okay, since the question has not mentioned about the redemption of the shares, we can't assume that it will be redeemed, because if we assume that it will be redeemed, then we have to assume when it will be redeemed. So we can't take so many assumptions in a question. So it is very simple to assume that it is irredeemable. Yeah, well, Sana, no, it's not about redemption value, because we can always assume the redemption will be at par value if no redemption value is being given. The only problem is the date is not mentioned. When to redeem? Are we going to redeem it after 3 years or 5 years or 10 years? So it is not mentioned there, so we'll assume that it is irredeemable. So the debt finance of Rupab company consists of bonds with a total book value of 2 million. These bonds pay annual interest of before tax of 7%. Now, what will be the cost of debt of irredeemable bonds? How will we calculate it? If we go back to the previous slide, we have the formula for cost of irredeemable debentures or bonds. Here it is. All we have to do is to take the interest amount, make it after tax, and divide it with the market price per share. So let's see how much interest we are going to pay. Is 7%, and the par value is $100. So 7% of $100 will be equal to 7. Then we have to make it after tax because it is bond and it gives interest, so it's tax allowable, and the tax rate is 25%. It says it's in arrears. At this point of time, when we are calculating the cost of debt, these arrears have no meaning to us, so just ignore it. So we'll take 1 minus tax, that is 0.25. Then we'll divide it with the market value. In this case, the market value is the same as its par value, so divide it with 100 and multiply by 100. So what's the answer? Hi, Sumera. We are getting your messages. Just check at your sound system, because there might be problem with your sound system, because everybody else is able to hear me. It's 5.25. Okay, thank you very much. It's 5.25%. So the cost of debt is 5.25%, whereas the cost of equity is 10.5%. Now all we have to do is to calculate the average cost of capital. And we have discussed the formula of calculating the average cost of capital yesterday. All we have to do is to take the weightage of debt and equity and multiply it with the cost of debt and cost of equity. So we are not being given with the weightage in this question. So what we have to do is we have to calculate the weightage ourselves. So I'll go to the next slide where I'll have free space. Tell me the total value of the equity we have. The equity value per share is 3.81. How many shares do we have? Okay, we have 5 million shares. We have 5 million shares, and each share has a value of 3.81. So let's calculate the value of equity first. 5 million into 3.81. Can you calculate this for me? 19050, right? Cross check. Everybody else should cross check it. Is it right or not? 19050. It's in thousands, right? Okay, it's in thousands. Okay. So this is the value of equity. How we have calculated it? We have multiplied 5 million shares with the per share value, and we got the value. And tell me, which value is this? Is it a book value? Is it market value? We have discussed the concept of market value and book value yesterday. So tell me, is it a market? Yes, it is a market value because we haven't multiplied the number of shares with the par value and adding the reserves. So we have taken the market value. And wherever the question is silent, and I told you that wherever the question is silent and it is possible to calculate market value, go for calculating market values. So now let's see the value of the debt. It is already given in the question, I guess. It's yes, the total. No, it's a book value. Look at the debts. In the debt section, we have been given with the book value. So can we use book value for debts and market value for equity? Never. Yes, never. If we are using market values, we should use market values for every type of capital, whether it's equity or whether they are debts. We have to use market value. So like with like, yes, Taha, right. So we have to use the market value of debt, but in the question we have been given with the book value. So we have to convert the book value into market and value. How we do it? Look at this. We have 2 million book value. What we have to do is to divide it with the par value. Why are we dividing it with the par value? To calculate the total number of debentures, because book value is always reported at par value. So if one debenture has a par value of 100, then how many debentures do we have which has a value of 2 million? So we have calculated the number of debentures actually by dividing the total value by 100. Now we will multiply it with the market value, which is also 100 in this case, but not in every case. Remember, not in every case. This is the usual formula for converting book value into market value. You have to take the total book value of the debt, divide it with the par value per debenture to get the total number of debentures, then multiply it with the market value of each debenture to get the total value. So in this case, since the par value and market values are same, so we'll get the same market value. Okay, so we have value of equity, we have value of debt. Now let's try to calculate the weighted average. So let's calculate the equity percentage first. How much equity do we have? 19050. 19050. Okay, I'm writing it in thousands, and I will divide with the total of equity plus debt. Can you sum total equity and total debts? Total equity plus total debts. 19050 plus 2000. Okay, 39050. Of 39050, we have 19050 of equity, which is how much percent? What's the percentage? Approximately 49%, right? Okay. It's 49%. Okay, if it's 49%, then definitely the debts will be 51%. So we don't need to calculate the percentage of debts. It's wrong. So recalculate the percentage. It's 90%. I don't think it's 90%. Okay. Oh, yes, you've made a mistake. Can you give me the sum of these two? I think it's not the correct figure. What should I write in the denominator? 21050, right? 21050, and it is 90%. 90.5. Okay, I can write it 91%. So it's 91%. If it's 91%, then the debts are only 9%, right? So 9%. Okay, let's now calculate WACC. Cost of equity is 10.5%, and we'll take 91% of 10.5. Cost of debt was 5.25%, and we'll take 9% of it since the debts are 9%. So what's the average value? WACC is 9.5%. Okay. Is everybody getting the same answer, 9.5%? And I want everybody to respond. Just write yes if you have got this question. It's 10.02%. Okay, let me calculate it then. 10.5 into 0.91 plus 5.25 into 2.09. Yes, it's 10.02%. It's 10.02% or approximately 10%. Yes. Okay. Is the voice clear now, Aisha? Is it clear now? Is it clear now? Okay. Because we are taking market values because market values do give the right answer. So it is a preferred method of calculating WACC over the book value. So wherever it is possible to use market values, we will always use market values. Wahab, I will try to fix it. Don't worry. You can contact me on other contact means. You may contact me on Facebook or you may WhatsApp me. I've just discussed how to calculate. This is the answer. How to calculate. This is how we convert book value into market value. We take the total value of debt divided with the par value of each unit of debt, that is per debenture, and then we multiply it with the market value of each debenture. Zirak, this Rubab company question is a past exam question. It's a December 2008 question. Simran, can you ask the question? What you want me to repeat? Taha, 10.02 or 10% is actually the weighted average cost of capital. This is the average that the company is supposed to pay to its investors every year. Yes, Zirek, I will give you a question at the end of the cost of capital topic. Don't worry. Well, similar, it will be calculated in this, sorry, Manish, it will be calculated in the same way. All we have to do is to use the value of the bank loan as the for the weightage purpose, because bank loan will not have any market value. So the same book value will be used as its market value. Why don't we use 3.81 as the denominator? 3.81, what is 3.81? Simran, what is 3.81? Abrar, we should always use market value as much as possible if we have the option. Okay, sorry. The 3.81, we can't use uh, we can't calculate weightage on a per share basis. We have to see of we have to calculate the weightage out of the total value of the capital. It is actually weighted average. Remember, weighted average, and a weighted average is always out of the total. So we can't take 3.81 as our share price, because the par value of the debenture will be 100. The market value of the debenture is 100, and the market value of the share is 3.81. It will totally distract our weightage. So we'll always use the total values rather than per share or per debenture value to calculate the weightage. Yes, Tala, we'll be discussing the theoretical part as well. Yes, Tala, I have to take everyone along with me. So be patient. We'll go. Don't worry. Okay, now let's move towards calculating the cost of redeemable debenture. We're done with irredeemable one, and we should go for redeemable debentures. No, 100 is not total. It's per share, per debenture. How? What are you talking about? Which question you're talking about? Yes, we use market value of debenture. Okay, let's move towards par value of debenture is always $100, right? Manish, we usually assume it to be 100. If the question is silent, we assume it to be $100 in ACCA exam questionnaire. But not necessarily it will always be 100. It might be different. It might have a different par value, but in the ACCA exam question, this is our usual assumption. Can debt to equity be more than 100? Yes, it can be more than 100. If your equity debts are more than your equity, definitely it will be more than 100. Yes, Simran, it will be assumed to be 100. So let's move toward this question: cost of debt of redeemable debentures. Now, how we calculate the cost of debt of redeemable debenture? I told you that in case of redeemable debenture, we have to use uh, the formula of IRR for calculating the cost of debt. Now, just listen carefully. Everybody should listen very carefully. Look at from the investor's point of view. We've already discussed how we calculate IRR when we are investing in a machinery or any other venture. So in the same case, say for example, Mr. A, he's going to invest in buying the debentures of a company. So he's investing. He might be investing in buying a machinery, or he might be investing uh, in buying somebody's debentures. So he will calculate his rate of return in the same way as he's investing in the machinery. So how will he calculate his internal rate of return? If you remember, when we were calculating our IRR, we were trying to calculate net present values at two different rates, one giving the positive NPV and one giving the negative NPV. So in this case, we will also calculate two net present values, one with positive value and one with negative value. So we'll assume two types of rates. And I told you there that we can assume any rate, provided that it should give us one positive value and one negative value. So to calculate the IRR, we need cash flows. How much cash, how much cash we will be getting every year. So look at this example. A company has 8% debentures in issue, which will be redeemed at $105 per $100 in 5 years' time. And the current market price of 100 debenture is 98. It means that whoever buys these shares, or whoever buy these debentures, will have to invest $98 today. So it will be the initial investment. So we'll write the initial investment here, which is $98. And initial investment is always written in brackets because it is outflow. So whoever is going to buy this debenture has to invest $98 today to get one debenture. So we'll always take market value as our initial investment. Against these $98 investment, what he is going to get? He will get interest everywhere, and the interest will be 8%. Remember, this 8% will always be applied to par value, and par value is assumed to be $100. So 8% of $100 will be $8. But since it is interest, it will go for tax savings as well. So we will make it after tax. The tax rate, are we given with the tax rate? No, there is no tax rate in the question. I am assuming that the tax rate is 30%. It will always be there in the question. So I'm assuming that the tax rate is 30%, so we'll take 70%. So 70% of 8 is $5.6 per debenture. So every year, against one debenture, this investor who is invested $98 will get $5.6 after tax interest. So this will be $5.6 every year. So it's actually annuity. For 5 years, he's going to get this $5.6 every year. So what we have to do is we have assumed a discount rate of 10%. So 5.6 into 3.791, can anybody multiply it for me? It's 21.23, thank you. So the total present value of interest amount that he is going to get during 5 years will be 21.23 at 10% discount, 10% discount rate. Okay, by the end of year 5, in case of machinery, we sell the machinery, we get the scrap value, and we write scrap value as our we write scrap value as a cash inflow. In this case, there will be no scrap value, but we will be getting the debentures redeemed, and we will get the redemption value. The redemption value will be, usually it's the par value, but not always. In this case, the redemption will be at $105. So Mr. A, who is investing in this debenture today, $98, will get $5.6 every year, and after 5th year, he will get $105 redeemed against this investment. So he will get 5.6 everywhere, and he will get $105 after the end of 5 years. So what's the present value of this? 65.21. Okay, 65.21. So the total present value of his cash inflows will be the sum of these two. What's the sum? 86.44, right? And how much he has invested? Okay, I've just written it in the wrong column. I should write it here. And the discount factor should always be 1 for initial investment. So we'll write 98. I'll deduct the investment from it. What will be the net present value? What will be the net present value? He invested 98, and he will be getting present value as 86.44. So it's 11.56 negative. Yes, Simran, I have assumed tax as 30%. It was not in the question, I've assumed it. So it's how much? It's 11.6 negative. Okay, so we've already got a negative NPV at 10%. So what we have to do to get it positive? Do we have to take a higher discount rate, or do we have to take a lower discount rate to get a positive NPV? Lower discount rate. So I've already taken it as 6%. Just multiply these figures with the annuity factor and discount factors of 6 here. So 5.6 multiplied by 4.212. 5.6, instead of multiplying it with 3.791 this time, multiply it with 4.212. 23.6. Okay, 23.6. Everyone should calculate this. We are multiplying 5.6 with the annuity factor of 6%, 4.212. It's 23.59, 23.6 approximately. Okay, then multiply 105 with 0.747, 78.4. Okay, add these two values together. 102.0. So, and the investment is 98. So what's the positive NPV? We have positive NPV of 4. Okay, let's now calculate IRR, which is actually our cost of debt. So we'll write the lower rate, that is 6. We'll write the positive NPV, which is 4. We'll divide it with the sum of the positive and negative NPV, that is 4 plus 11.6, multiply by with the difference of higher and lower rate, that is 10 minus 6. So what's the answer? Muhammad Talha, it can never be 11.02. The IRR should always be in between the higher and the lower rate. So remember, if you make such a mistake, you can trace this without calculating. Your IRR should never be more than 10% or lower than 6%. It should be in between these two. It's 7% approximately. Okay, right. So it's 7%. So the cost of debt is 7%. This is what the investor is getting. So it is called internal rate of return for the investor. And this is the same thing that the company is paying, therefore it is called cost of debt of the company. So it is a return for the investor, but it cost for the company. So that's why it is called IRR. At the same time, it is called cost of debt. So it's a very simple rule. What is purchase price for a buyer is a selling price for the seller. So what is a return for the investor is a cost for the investee or the company that is giving the return. So this is how we calculate the cost of debt of redeemable debentures. So let's take a break of 10 minutes, and so let's take a break of 10 minutes, and meanwhile there's a question on the screen, and forget about the conversion, or just solve this question for me, assuming that it will be redeemed. Assuming that it will be redeemed, and solve it during this break, and after 10 minutes break, I will explain it to you. Yes, Taha, be quick. What are you saying? Aisha, yes, there was no tax rate, so I assumed that the tax rate is 30% in this case. Tala, be quick. I have to change the slide so that everybody can solve this question. And everybody should take a screenshot of this slide of the question, and in between this 10% break, 10 minutes break, try to solve this question. Aisha, I just assumed the tax rate because I missed the tax rate while I was making this question. So I've just put it in the exam question, it will be given. I just wanted to show you that the impact of tax in the calculation. That's why I assumed it. Ubaidullah, if there is no market value and we can't calculate market value, then we have to use the book values. But as far as possible, market values should be used. Okay, take screenshot of this question, solve it in the break, and we'll discuss it after the break. Thank you. 10 minutes break, remember. Hi, hello everyone. Done with the question? Thank you, Aisha. Are you done with? Okay, let's start solving it, and let's see. A company has 8% convertible debentures in issue, which will be redeemed at 105 per $100 in 5 years' time, or converted into 20 ordinary shares of the company. The current market price of $100 debenture is $98, and the current market price per share is $5, which is expected to grow at 3% per annum. What will be the cost of debt of debenture? Now, what will be the cost of debenture? Before we calculate the cost of debenture, we would like to find out what the decision of the investor will be by the end of 5th year. What will be the debenture decision of the investor at the end of the 5th year? So let's calculate what comparison he will have at the end of the 5th year. He will have 20 shares, or he will have a cash. So what he will get upon conversion. So we'll need to calculate the conversion value. There's a formula for conversion value. What we have to do is just take the 20 shares. There will be 20 shares after 5 years. The current price is 5. It is not relevant figure for us. We need to have a share price after 5 years rather than the current share price. But to calculate the share price after 5 years, we need the current price. So it's a price. The price is of today, and it will grow at 3% per annum. So 1.03 for 5 years, so raised to the power 5. So what value he will get upon converting the debenture into 20 shares after 5 years? What value of shares he's going to get? It's $116. Okay, thank you, Aisha. $116. So the investor will have two options: to get shares worth $116, or get cash is equal to $105. You can't see my solution. Okay, wait. Can you see it now? Okay, so what I have done is I have taken 20 shares, multiplied with the current market price, and multiplied with the growth factor to get the share value after 5 years. It's $116. So after 5 years, the investor will either get shares worth $116, or he will get $105 cash. If you were the investor, what would have been your decision? Will you go for conversion? Yes, the shares will be converted. Okay, now let's calculate. Now forget about this 105. Now we don't have redemption value. We'll have conversion value in our question. Okay, we'll repeat the calculation. The only difference will be, we used to write redemption value earlier. Now we will write conversion value instead of redemption value. We write the higher of the two in case of convertible debentures, because this investor is not going to get $105. This investor is going to get $106 worth of shares. So what will be the interest? The same. It's 8%. And since again there is no tax rate, again I'll write tax rate so that you always know that what to do with the tax rate if it's given in the question. So I am assuming that it's 30%. So 8%, we have to take 70% of 8%, which is 5.6%. And if we take 5.6% of $100, we get $5.6. So the interest payment will be $5.6 every year. How we get these notes, as I have missed out the lecture. Okay, you will be emailed these notes. So we need to take IRR as 8% and something lower, right? Okay. Simran, we're just calculating the IRR. We are not arrived at the IRR figure yet. We are calculating it. So we have assumed the first rate to be 10% and the second rate to be 6%. And let's see what NPVs do we get. So every year we're going to get 5.6. The investor is going to get $5.6 in the form of interest, and upon conversion he will get $116. So just multiply 5.6 with 5.6 multiplied by 3.791. So it's 21.23. So 21.23 and then 116 into discount factor. Remember, we are multiplying the redemption value with the discount factor, not the annuity factor, because it's a single amount. So 0.621, it will be 72. 72 plus 21.23, 93.27. Okay, 93.27 is what he's going to get in 5 years. This is the present value of what he's going to get in 5 years in the form of interest and in the form of shares. Now, what he's supposed to invest against this? He's supposed to invest $98, the market value of debentures, because remember, we take market value because if the company decides to issue these shares today, it cannot issue the shares above the market price. Because if I can get something for $98 from the market, why would I go for higher value, purchasing it for higher value than $98? So there's no point of investing more than $98 for something that has a value of $98. So the investment required by the investor will be $98 against 93.27 present value. So what's the net present value? It's 4.37, right? 4.73. It's 73, right? It's 4.73. Okay, let's calculate the same values at 6%. So 5.6 into 4.212. 23.59. $116 multiplied by 0.747. 86.65 plus 23.59. So it's 110.24. Then we have value of investment equal to 98. So the net present value will be 12.24. So what we have to do is to use the IRR formula and put these values to get the cost of debt. So the lower rate is 6 plus the positive NPV, which is 12.24 divided by 12.24 plus 4.73 multiplied by 10 minus 6. So what's the final answer? Divided by 12 plus. So it's 8.89%. That's the cost of debt. So this is the only difference between a redeemable debenture and convertible debenture. So all you have to do is to first find out whether we'll be having the redemption value at the end of 5 years, or we'll be getting shares against it. So this is the only thing that we get. This is the only difference between these two. So I got 8.7%. It's okay. That's not a big difference, Simran. 8.7 or 8.89. There's no big difference between that. Taha, what will we do then? Go for shares? Definitely. We won't be going for the shares. The investor will be going for the shares. We have actually calculated the cost of debt. So at point 0, we know that if the shares will grow at 3%, by the end of 5 years, we won't be paying the shareholder. We won't be paying to the debenture holder. We will actually be issuing shares to him. Yes, the same, definitely. If you buy something for $10, somebody has sold it for $10, so it will be the same. I don't think you need to round it down. Usually round it off. Don't round it down. So usually round it off, but eh, the smaller rounding off errors will not make you lose any marks. But try to be as much accurate as possible so that you don't lose marks. The question does not, the answers do not deviate to a greater extent. Simran, I don't know what do you mean by is this a favorite exam question? But in exam, the question will be the same. Okay, all you have to do is to go for a Droxfall company. This is a pilot paper question. It's a very good question, Droxfall company. I have also shared the link. You just click on this link, you will get the question. And I will post my video on capital structure theories today, and do watch that as well. You will be able to watch it tomorrow. So I'll post it today, and this will help you gain the knowledge regarding the capital structure theories, how capital structure affects the value of the company. So you will have the video for that. So do solve the Doxfall company question, and I've also uploaded a Duo company question yesterday. So you'll be able to watch it on my YouTube channel. If you've done the Duo company question, have calculated the net present value of the Duo company, and I've posted the video on the YouTube channel. Yes, Sikandar, I will also post the video for asset replacement as well. So you can see that, watch that video as well. Weightage of cost of capital exam. Well, there I can't say tell about the weightage, but definitely you will find at least 5 to 10 marks from this area, either in the form of multiple choice questions or MTQs. It's a very it's one of the important topics. Well, I've shared my YouTube link at the start of this session, and I will again share with you people at the end of the session as well. So you can easily find those lectures there. Yes, Mohammed Talha, I will upload a video on capital structure theories today. So let's we're done with the cost of capital and the theoretical part. We've already discussed the limitations of CAPM. We have discussed the limitations of the dividend valuation model, and the other part of theoretical part of cost of capital is the capital structure theories, and you will watch that video, so we'll be done with the theoretical part as well. Now let's move towards our very next topic, that is business valuation. So when I try the company point of view, we're not able to positive present value shows a decrease in Abrar, we may discuss it later. Contact me on Facebook. We'll discuss it later. I will explain this point to you. Dania, yes, we'll try to do hedging as well, but I have to go and follow the sequence. How much of this topic can be tested in regards to theory? Aisha, well, it's not certain that how much it will be tested in theory, but there will always be a 60-40 ratio to calculation and theory. So I'm not sure what exactly will be asked at this time. So again, don't go for the guesswork, but the general ratio of theory to calculation will be 60 to 40. 60. So, Dani, I can't go for hedging first. Sorry, I have to follow the sequence because after cost of capital, I have to teach business valuation. These are the two connected topics. Sir, is dividend policy tested? The dividend policy is part of the business finance, the sources of finance, so it will be discussed there. Yes, it will be examined. Can you upload last attempt paper? Last attempt paper, you'll find it on the ACCA page. So do I really need to upload that paper? Okay, let's start business valuation. Hold your horses, hold your questions. I'll give you time to ask me questions. Let's start business valuation. What is business valuation? It's actually when you are trying to put a value to any business using any method. For example, if you go and you're trying to buy a cell phone, you will always have a value in your mind for a particular cell phone which you'll be willing to pay. So in the same case, if you're going to buy a company, you will have some value, you will have some calculation behind that value. So what ways are there which we can use to value a business? Before we discuss the models for valuation, we need to know the reasons why are we going to perform a business valuation. Well, for listed companies, you all know that the listed companies are the companies whose shares are being traded in the stock market. And since their shares are being traded in the stock market, they will already have a price of their share, and all you have to do is to pick the share price and multiply it with their outstanding shares to get the total value of the company. So isn't that's not difficult to do, but still we want to value listed company in some other ways. And why do we need to do, if we already have a value of a listed company, why do we need to calculate the value of a listed company? For listed companies, the reason is where there is a takeover bid. Well, why do we need to calculate the market value of a listed company if we already have share price of that? Remember one thing: if you go and buy a share of a company from the stock market, you will only buy the share. In that case, you will never get a control of the company, because you won't be buying more than 50% shares in the market, and you usually you will usually not be having 51% shares in the market, and everybody will be willing to sell the shares. So you'll hardly buy 1%, 2%, or 5% of the shares from the market. With those 5% buying of the shares, you won't get the control. But when you are taking over a company and buying more than 50% shares of a company, you will not only get the shares, you will also get the control of the company. So whoever will be selling more than 50% shares, he will be losing the control of the company. So he will never ever sell the share at the same price that is prevailing in the market. He will usually ask for a higher price because he is going to lose the control of the company. And what that higher price will be, that needs to be calculated. So for a listed company, we need to calculate the value whenever we are going to take over a company. We need to take the control of the company. We need to calculate the value. But for unquoted company, unlisted company, which is not in the market, whose shares are not being traded in the market, there is all the reason in the world to calculate the value, because you won't be having any value because the shares are not being traded in the market. So we need to calculate the value, and the reasons why we'll be calculating the value are: company might be becoming quoted company, it might be thinking of becoming a quoted company. So if they want to enlist in the share in the stock market, it needs to place a value to the price, to the shares, so that they know at what price they are going to issue their shares. Number two, shares of the company are intended to be sold. If you want to sell the shares of your company, since you don't have any active market, you're an unlisted company, so you have to calculate the share price in order to sell them. When there is a merger, when you're merging your company with other company, so you need to calculate the value so that the new value of the company can be formed. And when a shareholder dies, his shareholdings need to be realized, both for repayment purpose or for the tax purpose. So these are the multiple reasons for a business valuation. Now, what are the methods we use for valuing models? We have two broad categories of valuing business. One is the income-based models, and the other is the asset-based models. We'll discuss income-based model, but first we have to discuss the asset-based models. And what does the asset-based model mean? If I give you a balance sheet of a company and I ask you to calculate the value of this company, what you're going to do is you will add up all the assets, the values of the assets together, and then you will subtract the value of debt from it to get the value of equity. But these values are called book values. And the book values, we all know, the assets are usually recorded at their historic values, at the price at which they were initially bought, minus the accounting depreciation. So one way of calculating the value of the business is to total the value of the assets on the balance sheet and then subtract. Voice is not clear? Is it clear now? Is the voice clear now? Okay. So, what you do is you just add the values of all the assets on the balance sheet and then subtract the debts, because you have to pay the debts in case the company is liquidated. So what you have to pay for the equity will be the total value of the assets minus the total value of the debts on the balance sheet. But this is a book value basis, and we never use this method for valuation. It's only on the papers, and we never use it in practice. And the reason why we don't use it in practice is that the historic value of assets never ever represent the value of the company. Even if somebody asks what is the value of your cell phone, so there's one value at which you have bought it, but that has no meaning to the buyer. He will always negotiate with the price and keeping the value in the market rather than the value that you have bought it for. So we never ever use book values for calculating the value of a company. So it's only on the books. Sir is connecting the phone call audio method. So you never use book values. You never use book values to value the company. Then we have another value called realizable value basis. We may use this model, but again, we don't use this model usually. And I will tell you where we use this model. But what this model is all about. Realizable value basis means instead of taking the book values of the assets, all we have to do is to calculate their market values. Say, for example, I have a machinery in my books, and it has a book value of, say, $100,000. But I can sell it for $70,000 at the moment in the market. So I won't take it as $100,000 for which I have bought. I will just take its current market value, and that is $70,000. And I will take the market values of every asset wherever possible and just add them together to get the total value of assets, and then I will subtract the values of the debts from it, and to get the value of the equity. This is called the realizable value method. And even this method is not used for every company. This is called a breakup value basis, where you want your assets to be sold as assets and not as a business. When you are selling a business, the business comes with its tangible assets and intangible asset, that is goodwill. So when you are going to buy a business, it will never be sold at the value of its tangible assets. So a profit-making business will never be sold on a breakup value basis. You can't buy a business just by valuing its asset on its market value. It will always come with its goodwill value. But yes, we can buy a business which is not making any profits, which has no goodwill, and we can buy that business at its market values of the tangible assets that it has. So realizable value, remember, it can only be used for businesses that are not making profits, that are either making losses or not making any profits, and has no goodwill. So we can use realizable value for those businesses, and we can never use realizable values for valuing a business that is making profits, because even if we do so, the owners of the company will never sell it for that price. So there is no point of valuing a company at using this model. Then we have a replacement value basis. There are certain assets in our business which can't realize much if sold, but still has a value. They might be fixtures. For example, if you have a false ceiling installed in your business, it's a new false ceiling installed in your business. If your office is looking awesome with that ceiling, and it's great to have that ceiling. It's in a very good condition. It has been newly installed. But what if I ask you how much you will realize by selling this false ceiling? And your answer will be, sir, nobody will get it, because if we dismantle this ceiling, it will have no value, because it may not be used by anyone. So it has no active market. You can't sell it. But should I say it has no value? Yes, it has a value. So if I'm selling this business to anyone, I can't have the value of the ceiling that I have installed in the business, but I will just ask him if that what will be the value if I replace the ceiling. So these types of assets which are in very good condition, are used in the business, but cannot have any value if dismantled from their present location. So such type of assets are not valued at their market value. They are valued at their replacement cost, how much it will cost to replace them. So that will be their value. I hope you have got this point. Any question regarding this point, because this is something technical? Quick, you have 30 seconds to ask me a question. Did you get the concept of replacement value? So please explain realizable value. Okay. See, if you have, I just explained that if you have fixtures in your in your office, if you have fixtures in your office, and those fixtures, if dismantled, will have no value. But at the moment, they are in very, very good condition. But after dismantling, they will not be in a condition that they can be sold. So such assets will not have any market value, but that does not mean that they have no value. Anybody who wants to buy our business will have those fixtures. So if I remove the fixture, they will have to replace it. And replace, say for example, the fixture will cost $50,000 to replace. So if I'm going to sell my business to anyone, I will place 50,000 value on that fixture, say for example false ceiling. So I'll just say that if you replace this ceiling with new ceiling, it is already in a very good condition. If you replace it with new ceiling, it will cost you 50,000. So I'm giving you something worth $50,000. You don't need to replace it because you already have it. So I will ask the investor to pay $50,000 for such fixture because it will be replaced at a cost of 50,000. So now I hope it has answered you. Is this question counts for long questions or MCQs? It will be in section A or B of the syllabus. Okay, let's move forward. Now let's move towards the most commonly used models, practical models that we usually use for valuing business, and one of the models will be the price earning method. So let's go to the slide of price earning model. So we have a price earning ratio model. Okay, before explaining, I'll just point out the models that we have under income based model. Price earning model, we can value our business using price earning ratio. We can use it, we can calculate it using earning yield model. And we can have a dividend valuation model. We have already discussed it and we'll discuss it further. Dividend growth model and then we have cash-based models. So let's see what price earning model is all about. And you all know the ratio of PE ratio. You're aware of price earning ratio, I hope. What is price earning ratio? It tells you, it tells you, say for example, if a company has a share price of $10 and has earning per share of $2, what does this mean? Simran, I'll get back to this. Do ask me later. I will explain it again. Okay, just concentrate on the price earning ratio first. I will explain the realizable value. It's not that complicated. I will explain it. Okay, the price earning ratio. It means it's 5 times. So what does this mean? What does this imply? Well, if I am the investor and I'm buying a share of a company for $10 and I'm getting $2 as my earning, I'm actually valuing the share of the company 5 times of its earning. It means I'm satisfied of buying this share for 5 times of its earnings. So if it is giving me $2 today or every year, I'm going to buy this share for $10, that is 5 times. MPPS is a market price per share. It's the market price per share. And EPS is the earning price per share. So if the price of the share is 10 and the earning per share is 2, it means that the investors are buying this share 5 times at 5 times the earning of the company. This is what price earning ratio is. So we can use the same ratio to calculate the price. It's just a reverse calculation. So let us arrange this formula for market price per share. What we'll have to do, we have to divide price earning ratio with the earning per ratio to get the market price per share. This is the formula. So the market price per share will be equal to price earning ratio into earning per share. So if we use the same example, let's say we were given the price earning ratio, which was 5 times, and we were given the earning per share of the company, and we were asked to calculate the market price per share. We'll multiply it with 5 to get the market price per share, that is 10 per share. So 5 times means that 5 times of PE ratio means that the investors will be willing to buy the share for 5 times of its earnings. So all you have to do is to multiply the earnings of the company with the price earning ratio to get the value of the company. If you multiply price earning ratio with the total earnings of the company, you'll get the total value of the company. If you multiply it with the earning per share, you'll get the price per share. So it's very simple. So if you take the total earnings of the company, profit attributable to ordinary shareholders, we call profit after tax. So if you take profit after tax and after preference dividend, if we take that and we multiply it with the price earning ratio, we'll get the total value of the company. But if we multiply it with the earning per share, we'll get the price per share. So remember, like with like comparison. If you multiply the EPS with the price earning ratio, you'll get the price per share. If you multiply with the total earnings of the company, you'll get the total value of the company. Let's look at the question below. Alpha company, a private company, has earning per share of $1.8 per share. A similar sized company listed on the stock exchange has price earning ratio of 8 times. What does this mean? It means that this company's shares are traded at 8 times of its earning. If Alpha company has a total of 25,000 shares in issue, what will be the total value of equity using price earning ratio model? Now, remember, the price earning ratio is of a different company. It's not of the Alpha company. The Alpha company is a private company. It's not listed on the market. It does not have any active market price. So all we have to do is to pick a company involved in the same business. The only difference will be the status of the company, whether it's listed or not. So the company that we have taken is a listed company. So we'll take the listed company, we'll have its price earning ratio, and we will take this price earning ratio 8 and multiply it with the earning per share of the alpha company. If this company is valued 8 times of its earning, then we assume that since we are a similar company, we will also be valued in the same way. So if our earning is $1.8, our investors will pay us 8 times of our earning. This is what I'm assuming. Not it will not be in practice, and we'll discuss it later. But for the time being, we'll just multiply 8 with 1.8 to get, it's 14.4. Okay, $14.4 per share. So alpha company's per share price will be $14.4, but we are supposed to calculate the total value of equity. So what we have to do is to multiply 14.4 multiply by 25,000 shares to get the total value of the company. It's $360,000. Okay. So the total value of the equity of alpha company will be $360,000. Now, this is how we calculate it. We just take the PE ratio of a similar size company, which is a stock listed, which will be a stock listed company. It will have the similar level of operations that we have. The only difference between us and them will be the stock exchange. They are registered on the stock exchange. They are listed on the stock exchange. We are not. So that's the only difference between us. So we'll take that price earning ratio, multiply with it a share price to get the market value of our share price, the assumed value of our market price, and multiply it with the total number of shares to get the total value of the company. Well, how do we know if they have this have the same operations? Well, we will be in the business. Won't we be knowing our competitors, the strength of our competitors? I guess if we are in a business, we will be knowing our competitors, and we must know our competitors. So we must know the strength of our competitors, and this is not something difficult to find out. So now the question will be that, do you really think, I'm asking you people a question, just answer me with yes and no, then I will ask for further explanation whomever I want to ask. So be patient, just answer me in yes or no. Tell me one thing, do you really think an investor will value a listed company in the same way as an unlisted company? Okay, let me ask the people who are saying yes. Taha, let's start from you. Taha, tell me, why are you saying yes? If you are an investor and investing in a company, you see two similar size companies, one listed on the stock market and the other not listed on the stock market, will you still buy their share at the same price? If they have same earnings, remember I'm saying they have same earnings. The only difference is between the status. Taha, why would you want to buy shares of both companies at same price? Yes, because we made it like with like. Do you really think a listed company will have the same risk as an unlisted company? Don't you think unlisted company will be more riskier? The risk of a listed company is less than a risk of unlisted company. And the reason, let me tell you the reason. A listed company is on the stock market. You already have a share price at which people are willing to buy. So if you buy it at that price, you will know, you will be sure that this is the price that everybody is willing to buy. But unlisted company will have no market price. And if you buy it at the same price as of the listed company, you will never know that will you be able to sell it at the same price because it has no market. You might be buying it for this price. Maybe somebody else Don't see it like this, because it has no market. Since there is no active market for the shares of an unlisted company, there will always be a level of doubt that we may not be able to sell it at the price we are buying. So remember, a listed company's price will always be valued at a higher price than the unlisted company because of lower risk in the listed company. The confidence of an investor will always be higher on a listed company than on an unlisted company. So, but still we are using this 8 times ratio of a listed company for an unlisted company, So remember one thing, when we are taking a price earning ratio of a listed company for an unlisted company and we calculate the share price, we usually reduce it to half or maximum 2/3. So if we make it half of 14.4, how much it will be? 7.2. And what will be the 2/3 of it? 14.4 into 2 divided by 3. It's $9.6. So what we do is, we know this fact that a listed company will usually be rated higher than the unlisted company by the investors. So if for the first step, we'll take the price earning ratio of a listed company. We don't have any other option. So we'll take the price earning ratio of a listed company, multiply it with the earning per share of the unlisted company, for which we need to find out the value. Once we get the share price, we will then reduce it by 50% or reduce it to 2/3 maximum. This will give us a range for unlisted company price. So if we are to value a company on the pricing ratio, the range of the price will be from $7.2 to $9.6. We don't expect the shareholders to pay us 8 times as they are paying for a listed company. So remember, this is not a standard rule, but this is what usually we do. So in an exam question, if you're asked to calculate the value of a company using price earning ratio, if it's a descriptive question, which is least likely to be examined in the exam, but if it's a descriptive type question, you can write it between 7.2 to 9.6 with explanation why you've done so. But in case of an MCQ or MTQ, and the question is silent, then you have to write it 14.4, because it's an objective type question and no subjective things will be tested. This is a subjective matter. What value you place with your assumptions. So it's a subjective matter. In a descriptive question, you can state your assumption that why have you taken half or why have you taken 2/3 of the value. But for an MCQ, you can't state your assumption, so you have to be very much exact in calculating your value. So if the question is silent, you have to write $14.4 per share and 3,60,000 for the total. I hope it's what to select, 7.2 or 9.6. It will be in between 7.2 and 9.6, depends on other factors as well. So I've told you that in MCQ you should write 14.4, but for the descriptive type questions, you're allowed to write 9.6 or 7.2 with an explanation. Yes, if you state assumptions, you will be given marks. You must state assumptions wherever you assume something. So this is how we calculate. So then if we state assumption is section B, okay, should we take the average of 7.2 and 9.6? What assumption should we? No, we will not be taking the average. It's the upper and the lower limit. So you can go for 9.6 if you see the company is a very good company and has very good reporting standard. It does follow reporting standards and have internal audit department. So then you may rate it higher side. But if you see that the controls are weak and the reporting might have a risk of material misstatements, so then we can evaluate at lower price. According to the syllabus, no. It won't come in the descriptive part. It will be tested in the section A or B. So how did you came up with the fraction figure? Which fraction are you talking about? 1 upon 5 and 2 upon 3? Okay, this is what we normally use. This is just our assumption that if a listed company is being valued 8 times, we will be valued at 4 times or 2/3 of the 8 times. That is 6 times, I guess. Yes, listed companies are better than the unlisted companies, and the reason is that they have more exact requirements of reporting. The financial statements are usually free from material misstatements, since they follow standards, and then they have external audit they have external audit in their company. Their accounts are externally audited, so they are more regulated. Therefore, the confidence of investor on a listed company will always be higher than on an unlisted company. Well, I've already explained EPS for listed company and unlisted company. The unlisted company will usually have lower earning. So what are you saying? EPS. There's no difference between the EPS of a listed company and unlisted company. You have to divide the profit after attributable to ordinary share holders divided by the total number of ordinary shares. So it's the same for both. So let's move forward. What are the limitations of the price earning ratio? Sir, so is the value of the private company 7.2 into? Yes, the minimum value will be 7.2 into 25,000, and the maximum will usually be 9.6 multiplied by 25,000. So what to choose? I've told you that in a descriptive type questions, up to you. Just justify it why you're using 2/3. We can use, or you can state both. In a descriptive type question, we usually don't choose. We just explain things. So we have to explain the rationale behind having it 1 upon 5 or 2 upon 3, and I've already explained it because of the confidence of the investors. The listed company will usually be valued at higher side. Okay, the limitations of um, Momatala, you want to ask something? So in F9, is the EPS calculated like F7? We were Yes, it will be calculated in the same. There will be no concept of dilutive EPS here, but the simple EPS, the basic EPS, will be calculated in the same way. But it's not that complicated. Usually, you will be given the earning per share if it's a price. If it's the business valuation question, the price earning, the EPS will be given in the question. Even if it's not given in the question, you will be given the profits attributable to ordinary shareholders, and you will be given with the number of ordinary shares. So all you have to do is to divide. So it won't be that complicated. Let us discuss the limitations of the price earning ratio. Searching similar size proxy company will be very difficult, or choosing appropriate price earning ratio will be very difficult. I guess somebody asked the question, said, how will we decide that this company is of a similar operation? So it's a problematic area, deciding upon a similar size company, because they can't be exactly a similar company. You can assume some company to be a similar company, but in practice it will never be a similar company. There will always be difference. If not in the tangible asset, there will always be difference in the intangible assets. You have intellectual property, you have a great resource in the shape of human resource. The company, one company might have great minds in the business which are not reflected by the balance sheet of the company. So there will always be difference between the companies, but this is an inherent limitation. We have to assume a company to be similar if it appears to be similar. So it's a problematic area. This is one of the limitations of price earning ratio. It's difficult to find at a similar size company, number one. Number two, being a profit-based measure, it will be highly dependent on the assumptions or estimates used in the calculating profits. Yes. A listed company, might have a different profit because of different accounting policies rather than different sales revenue, or rather than different operating costs. It might be using a different method for depreciation. It might be using a different method for inventory valuation. So it might have different methods of accounting. So it might result in a different profit. So since PE, price earning ratio, is a profit-based measure of valuing the shares, the profit will be dependent on the accounting principles or estimates used. So there will be a difference. A single year price earning ratio cannot be used for a company whose earnings are volatile. Again, uh, if a company's earnings are changing every year and they don't give constant earnings every year, and if you use 1 year price earning ratio, which reflects only a single year earning, might disguise, might give us a wrong value for the company. So if a company has a stable earnings, we can use price earning ratio. But if it has volatile earnings, and if we still use a single year price earning ratio, we might come up with an abnormal value of the business. So the solution to it will be to use average price earning ratio for last 3 or 4 years, 5 years. This can be done. So we can solve this problem. This is not a limitation that cannot be removed. We can use an average price earning ratio of 5 years, and we can use that for valuing a company. So these are the limitations of price earning ratio. So another method for earning yield method. The other, volatile means fluctuating. Yes, it means fluctuating. Earning yield method is a similar method of price earning ratio. It will give you the similar value as price earning ratio because it's not different from it. The only way is the calculation, the way we calculate it. Otherwise, it's the similar as price earning ratio. And how is it similar? Let me again just look at this example. If a company has an EPS of 1.8, similar size company has a current market price per share of $16 and EPS of $2. If ACCA company has a total of 25,000 shares, what will be the total value of equity? Now, first we need to calculate earning yield. So earning yield is calculated. Remember one thing. Do remember one thing. Whenever you hear the word yield, there will always be a market price in the calculation. So whenever you see yield, there will be a market price. So it's earning yield. So earning means earning per share. And due to yield, what do you think? What should be in the denominator? There will always be a market price in the calculation whenever there is a yield. Yes, it's the market price per share. So whenever you see the word yield, remember there will always be a market price. So your calculation cannot be complete without incorporating market price. So if you're not incorporating market price, you're making some mistake. Do recheck it. So earning per share divided by earning market price per share multiplied by 100. So let's see. The company has earning per share of $2. The market price is 16 multiplied by 100. What's the percentage? Is it 11.25%? Okay. Is it 12.5%? It's 12.5%, not 11.25%. It's 12.5%. So it's 12.5%. Okay. Now what does this mean? It means that we are paying 12.5% against the investment value of $16. It's actually the return on investment. Why are we taking 2 and not 1.8? Well, 1.8 is the earning per share of the alpha company, the non-listed company. We have to use the earning per share of the similar company because we have to use the earning yield of the similar company to calculate the market price of the private company. So first we have to calculate the earning yield. That the way we calculated the price earning of the proxy company, this in the same way we are going to calculate the earning yield of the company. And yes, it is a reciprocal of the PE ratio. Rishab, you're right. It's the reciprocal of the earning per share. That's in times and it is in percentage. What if the similar company's EPS is not given? It's not possible. This is something very important to calculate the earning yield. If the EPS is not given, they might have given the earning yield. So if we have the earning yield, we will directly use the earning yield. We don't need EPS. So all we need EPS is to calculate the earning yield. So it's 12.5%. Now, look at this formula. Rearrange this formula for market price per share. Then how we can do it? So we'll just take the MPPS to the other side of the equation and we'll divide it. We'll divide the EPS by earning yield, multiply by 100. So let's now take the earning per share of the private company, that is 1.8. If Alpha company has $1.8 earning per share and the investors require 12.5% earning, what price they will be willing to pay? What's the price? Can you calculate the price? What's the price? Excuse me. It's the same 14.4, remember? So it's the same. So remember, whatever rule was applied to price earning ratio will be applied here. The 2/3 and 1/2 will be the same. And now let me explain. This is a listed company, right? And the shareholders are paying $16 for the share against the earning of 2. It means they require 12.5% return against the value investment. Do you really think they will ask for the same return from an unlisted company where they find higher risk? No, yes. They won't ask for the same return, because if they are going to invest their money into a non-listed company, they'll see more risk and they will ask for higher return than 12.5%. Say they will ask 25%, that is double the earning yield of the listed company. Now, if we take 50% here, 25%, sorry. If we divide with the 25% return, what will be the answer? It will be exactly the 50% of this. So 7.2%, right? So the earning yield method is similar to the price earning method and will have the same limitations as of price earning ratio. So let's move forward. We have already had enough discussion on it. So why you took different EPS in MPPS? Well, first we calculated the earning yield of the proxy company, which is not given in the question. In the previous example, the PE ratio was given, so we did not need to calculate it. But in this question, we haven't been given with the earning yield percentage, so we had to calculate the earning yield first. So what we did is we took the proxy company's share price, we took the proxy company's EPS to get the earning yield of the proxy company, and then we use this earning yield to calculate the market price of the private company, but this time we have used the earning per share of the private company because now we are calculating the value of the private company. So we'll take the earning per share of the private company into account. So let's move forward. We have a dividend valuation model, and we have discussed dividend valuation model in detail in the previous class. All we have to do is to apply it in different way. So why we have to find the same company for valuation purpose is unrealistic value for investor. Well, you can't say it's unrealistic, totally unrealistic. Yes, it won't be this exactly the same. That's why we have reduced it to 1/5 or 1/5 or 2/3. But we don't have any other way. We have to take values from the market, and we don't have any other way of valuing our company share. If we see a similar company is being traded at 8 times of its earning, we assume that our company will also be traded at the same price or somewhere around it. So we have to assume this. This is a limitation that we can't help it. Okay, let's take the dividend valuation model. Now, how we calculate the value of the share using dividend valuation model. Earlier, we used this model to calculate the cost of equity, remember? This time, we'll be using the same method. We'll be using the same method for calculating the market price per share. So we have arranged it. We have arranged this formula for market price per share. Look at this example. ABC company is considering to take over XYZ company. XYZ company has just paid dividend of 25 cents per share and has a cost of equity of 10%. If ABC company uses dividend valuation model for valuing shares of XYZ company, what will be the share price of XYZ company? So we need to calculate the value of XYZ company. We need to calculate the value of XYZ company. So all we have to do is to take the dividends that they have paid, that is 25 cents, and divide with the cost of equity, that is 0.1. What's the answer? 250 cents or $2.5, right? Okay, it's very simple. All you have to do is to take the dividend and divide it with the cost of equity. What you need to remember is the cost of equity should be for the target company which you are going to take over. Remember this. The cost of equity should always be of the target company. ABC company is considering to take over XYZ company. So we will never use the cost of equity of ABC company. We'll use the cost of equity of XYZ company. This is something that you need to keep in your mind. Don't do this mistake in the exam. Do not take the cost of equity of ABC company. Use the cost of equity of the target company. Let's come to the dividend valuation model. Dividend growth model, sorry. It's now the growth model. And we have already discussed the difference between the growth model. So let's solve it using the growth model. Assume that there is 3% growth in the share price. Sorry, in the dividends. The expected growth in the dividend is 3%. So we're expecting a 3% growth in the future. Let's calculate the same using the growth model. Just do it for me. Go ahead and calculate the price using the growth model, assuming that there is 3% growth in the dividend. How much? 68 cents. Okay. Let's put in the values. D naught is the current dividend. Remember, it's the dividend just being paid. It's 25 cents. Okay. And we'll have to multiply it with 1 plus G to make it the future dividend, because the very first dividend will be the one received after 1 year. So 1 plus 0.03 divided by KE minus G. The 100 is here. Okay. So do not multiply this figure with the 100 straight away. So KE minus G, the cost of equity is 0.1 minus 0.03. So what will be the final answer? 25 into 1.03 divided by 1 minus 0.03 multiplied by 100. It's the value will be So you don't need to multiply it with the 100 value because it's already 0.1. So you don't need to multiply it with 100. So what's the value? It's 367 cents. Okay, 367 cents or $3.67 per share. So now look at the difference. Where the shareholders were not expecting any growth, they were ready to buy this share for $2.5. The moment they start expecting a growth of 3%, they were ready to buy it at a higher price. So this is what the impact of growth is. So if you see different value uh, of price using different models, the examiner might ask to justify the difference. So one of the reasons of a different share price will be the expected growth. If the shareholders expect higher growth, they will be ready to buy the share at higher price. And if they expect a lower growth in the dividend, they will buy it for a lower price. Excuse me. I hope it's clear. Now, what if the cost of equity is not given in the question? How will we calculate cost of equity? Now, if we are using the dividend growth model for calculating the price, we can't use it for calculating the cost of equity at the same time because we can't find out two variables from one single equation. So my question to all of you, just come up with the answer quickly. My question to all of you is, what if we are not given the cost of equity? How will we calculate cost of equity? Which model of cost of equity should we be using? Exactly, it's the CAPM model. Good work, Sumer. So it's the CAPM model which we have to use. And remember, whose cost of equity we need? Which company's cost of equity we need? Target company, that is XYZ, the target company. So when you are using CAPM model, make sure you are using the figures for the target company and not for the investing company. So this is the key point that you should keep in your mind. Why CAPM? Because we don't have any other model left. There were two models of calculating cost of equity. We had dividend growth model and we have a CAPM model. So we are using dividend growth model already for calculating the price. So the only model we are left with calculating the cost of equity is the CAPM model. Did you get it, Abrar? Okay, let's move forward. Just quickly solve this question for me. Quick, be quick. Read the question and solve it. Manish, I told you earlier in the last yesterday's topic that a dividend valuation model and a growth model are same models. And if the question has growth in the question, Forget about the valuation model. It's a scrap model then. It's of no use. So the growth model and valuation model both are same. So if you're calculating something with using the growth model, uh, so you're actually using the valuation model with the growth. So we can only use the CAPM model. That's it. Okay, let's now solve it. Forbes company is considering a bid for Denoka company. So the target company is Denoka company. So this is the target company. Both companies are stock market listed and are in the same business sector. Financial information for Denoka company, which is shortly to pay its annual dividend, as follows. So it's the information regarding Denoka company. Remember the one we are going to undertake. So its number of ordinary shares 5 million, ordinary share price 3.3. This is what is in the stock market. So we already have a price of this company because it's a listed company. The earning per share is 40 cents. Okay, proposed payout ratio is 60%. Dividend per share 1 year ago is 23.3 cents, and 2 years ago it was $22 per share. Equity beta 1.4. Other financial information: average sector price earning ratio 10 times, risk-free rate of return 4.6%, return on the market 10.6%. Calculate the value of Denoka company using the following methods. We need price earning ratio. So using price earning ratio method, we have to find out the value of Denoka company. So what we need is the PE ratio and the earning per share of the company. So we'll take the industry PE ratio in this case and multiply it with the earning per share of the Denoka company. The Denoka company's earning per share is 40 cents. So 10 into 40 divided by 100 in order to convert it into dollars, it will be $4 per share. Right? Is it 4? Is it $4 per share? Okay. Now we need to calculate the total value of the share, so we need to multiply it with number of shares. So 4 into 5, it will be $20 million. So the total value of the company using price earning ratio will be $20 million. Now let's go to the dividend growth model. And for dividend growth model, we need cost of equity of Denoka company. So let's first calculate the cost of equity for Denoka company. We have a risk-free rate of return, which is 4.6%. We have equity beta of Denoka company as 1.4. We have market return 10.6, and we have risk-free rate of return that is 4.6. So what's the cost of equity? What's the cost of equity? It's 10.6 minus 4.6 into 1.4 plus 4.6. So it's 13%. So the cost of equity is 13%. Next step will be to calculate the growth. Let's calculate the growth. And we have the compound interest formula, remember? The latest dividend. Well, this is not the latest dividend. It's a dividend of 1 year ago. This is of 2 years ago. So we need to find out the latest dividend. Its proposed payout ratio is 60%. The earning per share is 40 cents, and of which 60% will be paid as dividend. So 60% of 40 cents will be 24 cents. So the latest dividend, the current dividend will be 24 cents. I hope everybody has got this. The payout ratio for the current year is 60%. The earning per share is 40. That is, the company has earned 40 cents per share, of which 60% will be paid as dividends. So 60% of 40 is 24 cents. So the current dividend, the latest dividend will be 24 cents. So we have to write 24 cents in the numerator. And can anybody tell me the earliest dividend that the company has paid? The earliest dividend. No, it's not the earliest. The earliest one is 22 cents, yeah, 2 years ago. So your dividend, the dividend has grown from 22 cents to 24 cents. Okay, in how many years? What's the difference between these two dividends? What's the time difference between these two dividends? Yes, 2 years. Yes, 2 years. So 1 divided by 2 minus 1 multiplied by 100. So how much growth is there? 24 divided by 22. 24 divided by 22 power 1 divided by 2 minus 1 multiplied by 100. It's 4.45%. Yes, it's 4.45% growth. Just wait a second. So the growth rate is 4.45%. Let's now put the values in the dividend growth model to calculate the cost of equity. So we have current dividend, 24 cents. The growth is 1.045, 4.45%, right? Okay, just 1.0045 divided by cost of equity, which is 13%, that is 0.13, minus the growth 0.0445. So what's the answer? So why the valuation of companies market share by? So Mayor, what's the complete question? I can't see your complete question. So 24 into 1.0445 divided by 0.13 minus 0.0445. So it's 2.93 cents per share, or $2.93 per share. So this is the calculation part. It's pretty simple and not that difficult. So now let's try to analyze it. We have a share price in the market which is $3.3. We have a share price predicted by the dividend valuation model, that is 2.93, and we have a share price predicted by the price earning ratio. So all the three are different. Why the market share by PE ratio and the dividend model is different from its share price 3.3. This is what I'm going to discuss, Samir. So we have got three different prices predicted. One is the actual market price. The other two are the prices that we have calculated using different models. Well, this is what is in practice. And these two are calculated based on assumptions, definitely. If you use any theoretical model, remember it will have assumptions. You assume things. Say, for example, if I have to predict marks of any one of you in F9 paper, I will have to assume things. Say, for example, I predict that one of you will be going to score 95%. Say 95%. And I hope every one of you get it. So 95%. Now, what I have assumed, I've assumed that you people will attempt the whole of the paper. This is only possible. It's only possible to get 95% when you have attempted the whole paper. So this is my assumption. That's assumption-based expectation. So any theoretical model will have assumptions. And if in practice the price is different, the only difference will be between the assumptions and the actual situation. Let us analyze the share price predicted by the valuation dividend growth model. Let's first see this one and compare it with this one. The actual market price is $3.3, which is higher than the price predicted by the dividend growth model. So it is higher than the price predicted by the valuation model, growth model. So why is the actual price higher than the price predicted by the growth model? And it is because of the assumptions that we have taken in the growth model may not be there in the practice. For example, we have assumed the growth will be 4.4%. Maybe the shareholders are expecting a higher growth than this in practice. This is what we have assumed, that the growth has been 4.45% in last 3 years or 2 years, and we expect it to be same in the future, but the shareholders might not be expecting the same growth. They might be expecting the higher growth than this. That's why they are purchasing the share for a higher price than this. Number one. Number two, we have used a cost of equity of 13%. We've used it as 13%. They might have expected a different cost of equity. They might be requiring a different rate of return than 13%. That's why the price is different. So if we compare it with the dividend growth model, This might be the reason. And one more reason. If you remember, the dividend growth model ignores the capital gain. It ignores the capital gain. It only values the shares on the basis of dividend. So in practice, the shareholders might be expecting the capital gain as well, which is ignored in the dividend growth model. So if in exam question you are asked to comment on the difference between the price predicted by the dividend growth model and the price actually prevailing in the market, you will have to discuss the impact of growth. And remember, if the actual market price is higher, it means the shareholders are expecting higher growth than the growth rate put in the formula. Number two is the cost of equity. They might be expecting different cost of equity. If they are valuing shares at a higher price, they might be expecting a different rate of return. Number third is the capital gain. Since the dividend growth model ignores the capital gain, but you can't assume the investors in the market to ignore this capital gain, so they will be expecting the capital gain as well. So these three will be the reasons behind the difference between the dividend growth model and the actual price prevailing in the market. Now let's come to the price earning ratio. The price earning ratio is predicting a price of $4, which is actually higher than both the actual price prevailing in the market and the price predicted by the dividend growth model. Now, why is that so? So the price earning ratio is the average industry ratio. It's the average industry ratio. If the actual price of the Denoka company is lower than the price predicted by the price earning ratio, which has actually used the average industry, it means that the Denoka company is a below average company in the market at the moment. And if the price earning ratio of the average market is used, it will be valued at $4, but at the moment the shareholders are valuing it at $3.3. So this price earning ratio model suggests a higher price, and this higher price suggests that this company should be taken over, as there is a potential for the company, for the Forbes company, to improve this company and take its price to a higher value than its current price. It means if the Forbes company, if it has a good management, it can take this average company above the market level and can increase its price to 4 or even above that. So for Denoka company, this value is very important in deciding whether to go for it or not. Yes, Muhammad Ali, what did you get? Sir, I couldn't get it. Muhammad Ali, can you? Should I repeat this? Let me repeat. If you remember that we have used the average price earning ratio. Yes, we have used the average price earning ratio, that is 10 times. We multiplied it with the EPS of the company and we got $4 per share. But the actual price is just 3.3. The actual price is just $3.3. What does this mean? This means that the Denoka company is a below average company in the market, because its price predicted by the price earning ratio is 4, whereas at the moment the shareholders are purchasing the price of this company at $3.3. So it may not be performing as the average market is performing. So if a company is underperforming, that company is best company to buy. The reason is that if a company is performing below average, you should buy that company so that you can use your expertise to make it perform better than the market and raise its value above. If it's already performing at its best level, it means there's no chance for improvement. Even if you take it over, you won't be able to improve it. And if you won't be able to improve it, its value will not go up. And if its value does not go up, you won't be having any capital gain. So the best company, remember, the best company to buy will always be the company which is underperforming, provided that you have enough management skills to make it perform better than the average market. did not understand the way did we we have market price, which is 3.3, which we Sikandar, can you just explain your question? I am not able to get it. So on the next slide, you have a written explanation, which I've just so far explained. So you have a written explanation on your slides, if you have the slides. So once the webinar ends, take some rest and then do read this explanation as well. We've already discussed it. So it's a written explanation of what we have already discussed. Manish, the potential of the Nokia company is 8.25 times. So we can use this statement in theoretical part in exam question. Yes, Manish, you can use it. If the company is already poorly performing, then how can reach to calculate at 4? Abrar, I didn't get your question. Remember, if a question is performing poor, if a company is performing poor, it's only then when you can have your expertise improve its performance. Otherwise, if the company is already performing at its best, it means it will have a maximum value, and if you purchase it at that point, you will actually be buying more for that. So, and you will have no chance of getting higher value than that. So it's always good to purchase something that has a lower value. And let me give an example. I guess Microsoft has purchased LinkedIn, and LinkedIn was, by the way, making losses. So it still purchased it, and this is how it should be. You can't buy something at its peak. You always have to buy something when it has a lower value, and it will only have a lower value when it's performing poor. So buy it at that point when its value is lower, so that you can improve the performance and you raise its value to a level that satisfies your required return. So I didn't understand how we calculated the price earning ratio. Well, I've explained it in detail. We haven't calculated the price earning ratio. The price earning ratio has been given in the question, that is 10 times. And to calculate the market price per share, the formula is PE into earning per share. We have already discussed it. So you just go back to the previous slides. We have a formula for calculating market price using the price earning ratio. So we just need to multiply with the EPS. So. Well, they can ask anything in the theoretical part, even where there's a multiple choice question. So you need to know at least the importance of different models, the limitations of their models. They can ask you in the MTQs as well. Yes, Sidra, you're right. We should buy something at a very lower price when it has a lower value, so that we can sell it at higher price in the future. So we are almost done with the business valuation. There's only one thing left in the business valuation, that is the valuation of the debts and the cash-based model. It's a very simple model, the cash-based model. So in the next class, we will discuss somewhat the cash-based model, what the cash-based model is. We will discuss how to value debts. It's a small topic, and we'll start business finance tomorrow. We'll start business finance tomorrow. Well, let's start risk management tomorrow. Let's start the risk management tomorrow. We'll start risk management tomorrow, and once we're done with the risk management, then we'll go for the business finance. Okay, my suggestion to all of you will be just try to go through the risk management section first. just have a brief introduction of the risk management so that when you are here in the webinar, you take highest benefit from it. Working capital management. I've actually shared what will be tested in section A, section B, and section C at the start of the slide, so you can go skim through the earlier slides. You'll find out what will be tested uh, in the exam. This is the slide which has everything in it. So if you just forget what will be tested in which area, you go back to this slide and it will tell you everything. So that's it for today. And do solve the Droxfall company's question. It's a very good question. Do solve it. And we'll start risk management tomorrow. So see you tomorrow. In fact, I can't see you people. So you will see me tomorrow. Good day. Thank you very much. Yes, sure. I will just post the video today for the capital structure theories. Don't worry. Yes, it will be from 10 to 1. Okay, yeah. I just need to share my YouTube link. It's youtube.com/EJAZ KHANEK. Don't forget to write EK. It's the initials of Ejaz Khan, so do write it at the end. You will get to my YouTube channel. And for the Facebook, you just need to write facebook.com/EJJAZ. That's it. So for Facebook, you just need to write /EJJAZ, and for YouTube, you should write /Ejaz Khan EK. So on your screen, there are my contact details. All the contact details are right on your screen, so you can copy them from there as well. Yes, everybody should try to revise the risk management section so you can get more benefit of tomorrow's class. Okay, thank you very much, everyone. Allah Hafiz.